So I'm Tyson Halsey. I'm president of Optima Process System. It's a startup, and we try to improve uh, process systems in the energy space. I also am the founder of an investment advisory. And so I look at energy and the whole ESG thing from both sides, the private as well as the public. And what really struck me and Marty that created this segment is that there has been this huge ESG wave over the last couple of years, which has attracted massive amounts of money. And it really lost a lot of credibility, particularly when it collided with the energy crisis, where essentially Europe in particular decided that they wanted to bet very heavily on wind and solar and get rid of their coal plants and their nuclear. And suddenly, before the Ukraine invasion, they already were in an energy crisis, and it became far worse. And frankly, the US is not far behind. They're basically wanted to make a jump, but weren't quite clear, that they had enough energy to make that. And it's created a lot of problems and higher prices. And so what I see and what we've been discussing here are what are the business opportunities that are growing out of these two factors. Another element, so that really had to do with the environment. The S for social. Last month we had Connect Our Kids, which is a very interesting nonprofit that used very sophisticated terrorist tracking technology along with Ancestry.com to take kids in foster care and link them back to actual family members. And there's an enormous benefit to these kids when they're actually put back in their families who some uncle that they've lost track of and they're too young, didn't even know that, they have a cousin who's in foster care. And so they had a very compelling presentation. And today, one of our three panelists is Lucas DeBreed, and he's going to talk about BrightEdge, and he is with the American Cancer Society, and they're basically a investment arm for cancer. And he will speak. He will then be followed by Jennifer Warren, who brings 2 decades of experience doing research in global economics and energy, and has a lot of experience looking at the energy transition and new technologies. And she'll speak for 10 minutes. She's published. She went to London School of Economics, is a fellow in the Next Generation Project at Columbia University, and has a podcast. And when looking at it, I saw she was seated next to one of my favorite money managers, Kyle Bass, and she also knows Richard Fisher. So she's very well connected, very sophisticated, and will be able to add a lot. And then lastly, but not least, is Bate of EP Valuation, where they value reserves, but he's really a finance expert, but he also does analyses of projects for their environmental impact. And he's going to talk about a couple particular projects that we've been discussing, but he brings substantial experience having worked at Schlumberger and Halliburton, and primarily working in terms of finance, in terms of putting together energy deals. So basically what we're going to do is go from Lucas to Jennifer to Bate. Lucas, could you kindly tell us about BrightEdge, and in particular, how family offices and startups, venture capital can integrate what you're doing, and what obviously any cure of cancer, is a step in the right direction. What makes your approach unique, and what is the impact?
Thank you, Tyson. Thank you, Tyson, for that introduction. And it's great to be here. So thank you also, Marty, for the invitation for us to be represented in this very special meeting. And it was a great start being invited to and being welcomed on a yacht in the marina. Certainly something that I never got to do living in the Bay Area for a couple of years. So thank you. And the program has been phenomenal. My colleague Steve Curtis was here yesterday, and I'm very delighted to be here with you today and be part of this panel. So Tyson already gave a very high-level introduction to what BrightEdge is. So BrightEdge is the impact investment and venture capital arm of the American Cancer Society. And why do we split those two pieces apart? We'll talk a lot about impact and ESG in this session, but venture capital is really how BrightEdge got started back in 2019. Idea was, the American Society should know a thing or two about cancer, and cancer has made a bunch of money for quite a lot of investors. So why would we not partake in that? And by doing so, actually create an alternative income stream for the society. So reduce dependency on the traditional donor funding that the American Society receives, which is in the order of hundreds of millions every year, thanks to the generosity of the American public. So since 2019, the model has evolved. So now we are wholeheartedly pursuing an impact investment strategy for our venture investing, which means in our book that we are pursuing both patient-level social outcomes, and so effectively trying to ensure that we can impact cancer from all angles, including prevention. So hopefully never having to be treated for the disease, and the disease never emerging in the first place. But importantly, that social outcome is paired up with financial returns. Because if we do not generate financial returns, then our model is automatically not sustainable. Automatically, we cannot syndicate, right? So we heard on the healthcare focus panel that in healthcare, there's so much risk, technical risk, regulatory risk, commercial risk. The only real effective way of dealing with that risk is to work together with other investors. Very few investors will take that risk on fully themselves. So if we want to be effective in achieving mission, we need to be a collaborative investor, and hence we need to align with the objectives of the financial investors as well. So that's why both patient-level outcomes as well as financial return, for us, we're looking for that Venn diagram, and that really constitutes the kind of the core of what we are doing. And so right now, the venture fund, which we call ACS Impact Venture Fund, or AIVF colloquially, is about 80 million in net asset value. And we've done 17 investments, had 4 exits. We invest in everything that touches patients' lives. So from a more traditional modality standpoint, that's therapeutics, medical device, diagnostics, and health IT or health tech, so software-based solutions. And we typically invest at the point of the Series C or Series A. And, depending on the opportunity, that can be in the order of several 100,000 or several million, and then we can scale it up to about 8 to 10 million total over the lifetime of the investment. We're set up as an evergreen. So again, the returns that we produce flow back, and hence it's a perpetual vehicle. And importantly, we also plan to issue a dividend back to the ACS. So actually fulfill that opportunity of actually generating returns that then flow back into the American Society and actually help fund the safety net activities that the American Society provides, as well as the important advocacy work that's being done both on the Hill at the federal level as well as in state capitals. Last thing I'll say is that for us, it's also tremendously exciting to see the level of appetite that individuals have shown. So that money that we're managing currently comes largely from the ACS investment pool. So we are basically the beneficiaries of the VC allocation of that investment pool. But we have also been fortunate to inspire individuals, oftentimes at family offices, so high net worth individuals, to become part of what we're building. And so we started an activity called the Founder Circle, which has currently a minimum participation of 500,000. And so it's philanthropic, right? So there is that benefit also on the fiscal side of things, but effectively that allows individuals to get involved by donating some of their wealth for us to put to work and thereby realize our investment strategy, and hence deliver on mission in line with what the American Society represents. And so we now have a dozen of these Founder Circle members, and we're very keen to build that group out. We have a few of them actually here in the Bay Area. So I mean, there were already some core that we're building here, and we love to really create that community of like-minded people that believe that in order to affect social change, venture capital or other financial products that we're still currently having in the laboratory, that's one of the most effective tools, right? And I think a lot of people, particularly here in the Bay Area, have seen what venture capital can help produce, not just in terms of wealth, but also in terms of actual social change, right? Really lifting people up, creating jobs, and actually making people's lives better. So we really like the fact that people have followed us in what we're trying to build and are actively collaborating by not just their donation, but also by activating their particular resources and background. I'll stop there.
What round do you invest in?
Seed on Series A as a typical starting point. We can do both. So thank you. Oh, sure.
So the ESG policies apply across the board department at the site.
Yeah, thank you. I mean, of course, this is a panel on the ESG, so I didn't even go into that topic yet, but I thought, yeah, I'll just try to give you an introduction, and we've got some more time to talk about it, but I'll take your question. So we actually have started a dedicated group to look at DEI, which is sort of our, call it, version of ESG, at least our interpretation of ESG, which, you know, for us, we're really in the social side of things, right? Clearly, yes, the society has an environmental footprint, and of course, with a lobbying organization, right? And even us, you know, we as investors, we influence governance, right? How does the board of a company look like? We have influence there, and that should represent the right ingredients. But we tend to be very deep on social, and that's where we have a very, very strong focus on health equity and DEI. And so we have an actual officer for DEI that is currently doing exactly what you're asking about, is to basically build that out further in terms of the common fabric of all of the activities that we're doing. And so, you know, for us as an impact investor, we're very focused on patient level impact. So how do we, you know, deploy our dollars? How do we make those dollars work as hard as possible to really impact the lives of patients? And so, again, that sort of impact framework that we've developed, where we bring all of the wealth of knowledge that the ACS has to really understand, you know, what's really at the heart of what the patient has to navigate. That for us is still, again, is pure impact. So to Marty's point, that we're, for us, ESG is something completely different, but ESG is certainly important for the society at large. So we sit within S because that's where patient level outcomes really live. And that for us is where we've developed our own framework to navigate opportunities for investment. And we use that to report as well. We create accountability around it. It's not just to kind of check a couple boxes. No, we actually guide our investment decisions at the outset, and also follow-on investments based on us tracking towards delivering on those patient level outcomes. So that's sort of where impact and ESG are different, but they both are relevant for the society. Thank you for your question. I think you've heard enough from me, so I'll gladly pass it on to
I got one
group.
for you.
Oh, okay.
You don't get away that easy. So, are there any family offices that have gifted to you? And what about corporates? And the reason I ask is I'm wondering if somebody says, hey, that's really great, you know, what the tax benefit is and whether they do that and how they might go ahead and do that. And also with some startups, I know that one of our panelists a month ago was saying he gave $50 million to a software company, but he required them to contribute a fixed amount of their revenues to a nonprofit. Do you have any relationships like that you could describe to give people in the audience maybe an idea of ways they could help you?
Yeah, thank you. So yeah, just to build on what I said earlier, our group of Founder Circle members, most are making that commitment through their family office, but really on the philanthropic side of things. We are in active discussions also to move into other forms like donor advised funds, grants with recovery. So to really also work with the family office in different pockets, if you will, of their portfolio. And again, we welcome those discussions as well. We're actively innovating, so it's just great to work with family offices to try to see what's possible in order for them to be able to support mission. And we're not that centered on one form or another. We're actually very open to explore other ways that are preferred by the family. So as I said, we have about six or seven current Founder Circle members, and we'd love to build that group out. So welcome any opportunity to engage with the group here in the room or online today. As it pertains to corporations, that's a relatively more recent focus that we're building out, and there we primarily are talking to the foundations again. So just to have that more philanthropic grant that corporates provide, right? So a lot of corporates do that sort of as an extension of their corporate social responsibility focus and initiatives. Yeah, they're sort of an obviously an interesting match with a lot of the corporations in the healthcare space today. So we're having those discussions, but we're also very keen on other foundations. So it's just the Visa Foundation, which you probably all know is very active and really a front runner in the impact investing world, launching key initiatives to actually further that relatively young sector. It's only been around for about 10 years now, impact investing. And so, yeah, those are great opportunities for us to pursue, particularly given that even though, of course, cancer is a disease, it's healthcare related. We all know that healthcare is 20% of the economy, and well, every one of us here in this room and online will know someone who has been struggling with cancer, right? So it's now the #1 killer, unfortunately, in the US. So it's a grand societal challenge for us to deal with. So by no means should that therefore be restricted to healthcare-focused organizations or corporations. Every corporation, every employer has to deal with cancer. So, but yeah, we're a small group. We're only up and running for since 2019, so only about 3 full years under our belt. So again, any guidance there, any recommendations, we'd love to work together and collaborate because yeah, we can certainly use help in that regard. And so hence Founder Circle members, family offices, and high net worths that are inspired by what we can do and are really also wanting to roll up the sleeve. That's why we call it Founder Circle, right? It's actually people that are, in that sense, still part of what BrightEdge can become. It's not just write a check and good luck type of interaction. So hopefully that answers your question.
Thank you. You did a great job. Any questions from the audience, or should I move forward? Jennifer Warren.
Hi. Can you hear me okay?
I forgot to mention that you were the CEO of the Dallas Committee on Foreign Relations, and you've sponsored a bunch of things. So that's just one more feather in your cap. Tell us what's going on in energy and green technology, and what are you? You've done a lot of research.
Well, so my consultancy, so I'm the founder principal of Concept Elemental, and I do research. I'm like a research analyst in energy resources, geopolitics, but also communication strategist. And I do a lot of produce thought leadership communications in that space. I have a YouTube channel at conceptelemental.com, and I have a lot of videos and a deep bench of prolific writings on the topic. But there was 3 videos, they're kind of a trilogy this fall that are on my YouTube channel. And then one I just did today actually posted with Seeking Alpha, and it's my outlook. And so I'm going to frame this a bit with ESG, but so, obviously, like Tyson mentioned with the Russia's invasion of Ukraine, it sort of, started redrawing the energy map. It coincided with many things. For one, the ESG lens before the Russia invasion, ESG was having a tendency to create underinvestment in the oil and gas industry just because they were concerned about demand destruction, with the energy transition. And we saw that movie in Europe. They were first movers. They moved faster than us, the United States, in their green push. And the cracks in that started showing even before the Russia invasion. And now, and then we have a pandemic. We have the Russia invasion. So it's really sort of, it's redrawn maps. It's also what has partly led to the third of the valuation of the triple Q drop. And also you couple in interest rates with that, where, there's a higher bar to to do projects now. So all those forces are weighing in. And now the irony with ESG in the oil and gas industry is that, the new IRA legislation, the Inflation Reduction Act, it's $260 billion of tax credits and subsidies for green ventures, largely in energy. And like of the 260 billion, like 130 is for renewables, wind, solar, storage. And there's about 14 billion for CCS, carbon capture and storage, and 22 billion for hydrogen. And that's coupled with the former infrastructure bill. So now you have oil and gas firms that are starting to really differentiate their strategies of, how they're going to reduce carbon emissions and greenhouse gases. And so I think you're starting to see, you could call it ESG, but really I call it just sustainability. Oil and gas are going to be with us for a long time. With the Russia invasion, that became clear. And we're never going to completely electrify the grid with renewables. We need density. Density is a driver. That's why fossil fuels are powering like 82% of the primary demand is met by fossil fuels. So, but the fossil fuel industry, oil and gas, understands that they have to, deal with the externalities, i.e. pollution and greenhouse gases, which, are contributing to global warming. And speaking to your cancer, pollution, lung cancer, all that, my mother passed away from lung cancer. So I get the pollution issue. I get the air issue with all that, that externality. But I think, the industry is trying to redress those externalities. And like out of 41 oil and gas companies, this is from Bloomberg NEF, they're spending about 6.6% of their CapEx on low carbon ventures. And that's going to increase over time. And so that's one area. And I think this IRA legislation actually gives a boost to the impetus for the low carbon drive. But aside from like CCS, carbon capture, CO2 is used in enhanced oil recovery. And I just, in my video from today, and it's on my YouTube channel, I talk a lot about a presentation, Scott Sheffield, he's Pioneer Natural Resources CEO. And Pioneer is like a leader in the Permian Basin. The Permian Basin, and that's something I've chronicled all the booms, the gas boom that started roughly 2005-06, the oil shale boom, 2013 was the real big advent of it. I've been chronicling those for, almost 2 decades now. And the Permian has become like 5% of the oil market, and it's a big player now. And right now, they're projecting it to still grow by another, like, it's at 5.5 million barrels a day. Global supply is roughly 100 million barrels a day. That's supposed to increase to about 6.57, call it 7, up to 2030. That's when the projected peak is of the Permian. But then it's supposedly supposed to just plateau for about 3 decades. And part of that is going to be met with enhanced oil recovery. That is being more sustainable with oil production, getting to the last drop, so to speak. I mean, we're never going to get to the last drop, but there's definitely a will to do it better, to do it more efficiently, to make these resources count. And that's coupled with, renewables, energy transition, hydrogen, CCS. Again, I detail this 2 minutes in my just my recent YouTube video, but so that's sort of what's going on with the ESG lens with respect to oil and gas. And yes, that IRA legislation is incentivizing a lot of renewable capacity installations. There are issues with that to do with minerals. We have geopolitical issues surrounding that with supply chains. And the other thing I want to mention is just energy tech. Large oil and gas firms, that CapEx they're spending, that I think is like 300 to 400 billion in 21, that will increase, and they're going to be buying firms that are technology leaders to help them solve the issues of externalities. And I think you're going to see a lot of interesting collaboration in the future. You're going in oil and gas, there's a lot of free cash flow, and the industry is set up really well over the next 5 to 7 years. There's a huge, all the sophisticated capital allocators I know are very bullish on oil and gas. And so there's going to be this free cash flow. There's going to be CapEx. And I think they're going to be, in some respects, leading, in certain ways, the parts of the energy transition to do things better because they have the scale. And so we're going to see this resource efficiency push. And that's kind of my themes for the year is efficiency with resources, efficiency with capital, because the other side of that equation is that oil and gas firms are returning very good dividends to their shareholders. Some of them are doing buybacks, but my preference is the cash back because I want to have control over my money. So you're going to see them, also investing in, how we do this more sustainably, how we, not just that they're tethered to ESG, it's just sustainability. ESG, some firms embrace it, and others, there's a skepticism about it. And again, I just like the lens of, sustainability. What is sustainable? Sustainable capital, sustainable resources. How do we run the planet sustainably? It's a bigger imperative, and I think it's going to require scale, especially when you start adding all the technology stack that we have that requires energy as well. I'm trying to think if there's any last thing. I was going to go into some of the fundamentals, Tyson, but that I just don't think we have.
I think you're
time, so
I think you should just stop right there.
Yeah, I'm
So
done.
what I want to do is make sure that everybody's information, people sometimes say, how do I get a hold of Jennifer Warren or Bate or Lucas DeBreed? Make sure your contact information is so that they can send money. To Lucas, these other guys don't take it. But I wanted to make sure that was there. But you really set up Bate really well. As I said, I have a startup and I was shown a project to buy for $100 million, a bunch of natural gas properties that are producing, and it has very good free cash flow. And it was a broken deal, and now we can buy it even cheaper. And I looked at it and I called up Bate because of his work in terms of measuring greenhouse gas emissions and the like. I said, well, how would you suggest that we go ahead and make this more ESG friendly, and what would the economic impact be on that? And he said, well, we could cap off certain wells that, you know, are leaking methane, and we could replace certain pumps with electric. But I don't want to take away from Bate's expertise, but there were actually two other deals that he will talk about that are also indicative of operations now that are evolving, and so that they are greener. And I think that one of the things I just point to that some of the people in the audience may not realize is natural gas prices have declined sharply this year, at least since April following the invasion of the Ukraine. And so buying some of these assets, they can be very remunerative, yet we could also be doing something that's good for the planet. So we're interested, Bate, myself, in looking at deals. So if any of the family offices are interested in exploring that with us, please let us know. Go ahead, Bate.
Thank you, Tyson. Thank you, Jennifer. That was an excellent setup. It's funny. I feel like I should just go home now. So my background, just quickly, my background is I'm a professional engineer, a bachelor's in petroleum engineering from Montana Tech, and I worked for Schlumberger for a few years. Went back to grad school, got an MBA, and worked for a small company called Remington Oil and Gas. Remington had operations onshore and offshore. I spent a lot of time in both locations and rigs and all that good stuff. But more important, we built the company from a few properties and sold it for $1.4 billion in 2006 to Helix Energy Solutions Group. Those properties are now the base assets at Talos. Talos acquired those properties in 2012 and built upon them. So a lot of these discoveries we had at Remington and now Talos. I bring this up because when you go through that process of finding reserves and then selling them, you learn a few things about how the oil markets work. And in 2000, when I left Remington, I joined the bank. Actually, in September of 2008, I left Remington, or then Helix, and joined MUFG Union Bank, which at the time I was like, Lehman collapsed a week after, soon after, and I thought, did I make the right decision coming to the bank side? But it has worked out. At Union Bank, we funded about $3 billion worth of deals. I was there for quite a few years. Then in 2018, I joined ING, and as head of their technical group, I oversaw the valuation of a $4 billion energy portfolio. So I've seen a lot of deals. My firm, EP Valuation, today we do about 100 deals, 100 reviews a year for clients, banks, investors, and operating partners. And deals range from $25 million to $5 billion in transaction value. And what we do for them is we provide technical due diligence, we provide asset valuation, and most important in this market, we provide ESG reviews. And our goal is to empower our clients to make good decisions in what is a challenging energy market. Now, I'm going to segue real quick to the two deals we talked about, Tyson, because I think Jennifer covered a lot of the fundamentals in the oil and gas business. I don't need to rehash those. So, when Russia invaded Ukraine, the market changed, right? We went from normal oil and gas to, well, we need oil and gas to survive. And that is always the case. In 2010, Munich Re put out a paper that said, this was the last of cheap oil. Well, there's some cheap oil like 3 times since 2010. So the market is constantly changing. Where we are now in terms of ESG in this market is we are trying to figure out what we can do with a resource that is not going to go away, but how can we produce this resource more responsibly and be aware of the needs of the planet as well. because it's not either you choose oil and gas or you choose the planet. You need energy and you need a safer planet. We can do both, right? Maybe not immediately, but we can gradually build the skill to do both. In 2022, natural gas provided about 60% of US energy generation, right? Solar and wind combined made up for 1% increase in solar generation. I bring this up because we need more solar and more wind, but until they scale up, it will be difficult to replace natural gas. The primary change in the energy mix has been coal, right? Coal has been disappearing in the US energy mix, and the natural replacer of coal is natural gas, right? That's just the fact, that's just how the market is now. So it will be with us for the next probably a few decades, I would say, right? Having said that, on January 3rd, Reuters published an article that Tokyo Gas is acquiring Rockcliffe Energy. Tokyo Gas provides about 14% of Japan's LNG imports. They've been a long company in the US, they have assets in the Haynesville, and they're buying Rockcliffe Energy, which is a private company. This acquisition, it's a $4.6 billion acquisition, will actually quadruple Tokyo Gas's daily production. What is important in this deal is that Japan has to find new sources of natural gas from friendlier jurisdictions, of which the US is one. The US has plenty of gas to spare. The other thing is that the Haynesville, when Rockcliffe is close to LNG export terminals, again, which is in favor of a Japanese company wanting to move LNG home, right? But on the ESG side of this deal is the fact that in 2021, Tokyo Gas contracted a company called Project Canary through their Trust Well certification process to become what is called a responsibly sourced gas company, which means that you've met high standards in the industry for methane reduction, better use of water and fracking technology and drilling, and you get this designation. Very few companies have that designation. In 2022, Rockcliffe actually acquired that designation. So here's a company from Japan that is thinking, well, we need to be energy efficient, but we need friendly energy. And so we're going to buy from the US, but also going to get a certification so that we're ESG friendly. And here's a US private company that has already arrived at ESG friendly, right? And the marriage is happening at $4.6 billion because the two companies are aligned in their thinking about climate, about environmental concerns, and about efficient field operations. Because what we often ignore in the ESG battle is that it takes money to be ESG friendly. And companies don't always have it to spend, especially in the downturn. That's one. Two, when you do have it to spend, you want to make sure that it's accretive to your operating expenses. And so what Rockcliffe did and what other companies that achieved this designation have done is they switch from diesel generators or diesel compressors, if you would, to electric compressors. They go from diesel powered frac fleets to electric frac fleets. They go from single fuel drilling units to a bi-fuel, more efficient drilling unit. And so you need fewer operators to manage your operations because electric units need less maintenance and can run for longer without having to change oil, fewer chances of a spill. When you put that together, you come away with companies that are using ESG, not just as a buzzword, but as a push for more efficient operations that benefits their bottom line, right? And when we review companies from an ESG perspective, we ask three simple questions. Is this company and is this asset profitable through multiple commodity cycles? And the reason for that is a company that is struggling will not follow through on ESG commitments. They just won't. The second question we ask is, does this company that is seeking funding or investment dollars, does this company have a plan to decommission its sites, P&A wells, clean up field locations? Because to Jennifer's point, it is not sustainable simply to plan to sell your wells to a smaller company and avoid P&L liabilities. We want to make sure that each client that we review and onboard has a plan to decommission its sites. And the third is we have been encouraging banks and other financial partners, and this is a difficult push, but it shouldn't be, to provide incentives to their clients to meet responsible gas certification. So I have a mortgage, most of us do. You get probably a half point off your mortgage, or a quarter of a point off your mortgage if you escrow taxes and insurance, right? Because banks have realized clients, lenders, borrowers who escrow mortgage, taxes and insurance are less likely to default on their loans. That's one. They're less likely to default on paying their tax bills, which then puts the city in priority of the bank, but also less likely to let the insurance lapse. And I think that banks that have been pushing for this with some of my clients should provide an incentive in the pricing grid and say, if you meet this designation, we will take a few bips off your pricing. If they do that, you'll see more companies racing towards an ESG designation because it makes financial sense for them to do so, as opposed to, well, I'll be punished if I don't have the cleanest operations. Give them an incentive to build better operations. Most engineers want to do things better, but somebody has to pay for it. So I'll stop there for now, and then we can pick up conversation.
So I want to just say something. I've been very interested in the whole market opportunity to take cheap US natural gas and sell it abroad and use liquefaction to take natural gas, freeze it, shrink it 600 times, put it on a ship and ship it abroad, whether it's to Tokyo, India, China. India and China happen to produce tons of carbon emissions. They're burning tons of coal. A lot of people don't realize that the significant improvements in carbon reduction in the United States has been driven by the substitution of burning coal for electric generation and replacing it with natural gas. And in fact, that some people argue will make a huge difference. And a lot of the stuff that we're doing is really just, it's a rounding error. And what we need to do is get natural gas over to China and India. But the point is, we have very cheap natural gas in the US. It's about $4 per MMBTU, and I think it's about 25 in Europe, and I don't know, 20, Jennifer, I don't know, or Bate. But the multiples are significant. So this is a real opportunity. And Bate, could you address, for example, what kind of returns you could expect if you are investing in natural gas wells and fixing them up from your experience, just ballpark? And you're on mute.
Yeah, thank you. So in the fourth quarter, on the deals we looked at that were purely natural gas deals, Haynesville, some Eagle Ford, and some Marcellus. Marcellus is slightly different because of the long-term contracts you have to have for firm transport. But Haynesville and Eagle Ford Shale, most of our clients were breaking even at about $2 on current wells, just because production is much higher. They're expensive to drill, but these are bit longer lateral wells, which is much higher. So you can expect returns at $2 gas break even, right? So at $4 gas, you're doing quite well. And that's just where the market is right now. The challenge, I think, with the natural gas market is high declines, right? So you have 50-60% declines in the first year. So you can't simply drill and forget it. You have to have an active development process to maintain rates, maintain profitability, and hold costs down. Does that help?
Yes, it does. Questions or comments? Jennifer?
Regarding like LNG, and I mean, with China reopening, one dynamic that's supposedly going to happen is that with the EU importing more LNG now, Germany is spending like $350 billion on building LNG facilities. And up to like the next several years. And they're going to be competing with China for cargoes. That could put pressure on price. The other pricing issue, and this was by way of Scott Sheffield's presentation, Henry Hub is at $4, and he believes it will be more in the $6 range long term. And that's because over time, you're going to have the globalization of natural gas prices. You're going to have convergence over time between Europe, Asia, and the US. And this advent of an increased LNG will make that happen over time. Because one thing is, Europe is not going to go back to sourcing from Russia like they did before. That ship sailed. Putin didn't realize, but he changed everything. He changed the drawing of the natural gas map when he invaded Ukraine. There's diversification amongst the European countries of their sources. Germany's getting more from us, Qatar, that sort of thing. So definitely it's a natural gas world, and yes, it will help emissions over time. So.
Excellent. Marty, are there people in the audience who have questions?
Yeah, we have a question.
Yeah, I have a question for Bate. When you're looking at the portfolios, when you're looking for ESG policy compliance, I guess, are you also looking at the ecosystems around those sites as well, and considering the natural habitats?
So when you look at ESG, are you in compliance? Are you looking at natural habitats and ecosystems?
That's an excellent question. My firm specifically, no, but we get reports. We require reports from other firms that are, because there is an environmental compliance process that most companies have to go through. And it differs by state in terms of its rigorousness. But yes, there is, Texas, New Mexico all have regulations about environmental cleanliness and monitoring. So we don't do that. Our firm doesn't do that, but we get reports from companies that do. Project Canary, for example, is one such company. Right? If you hire them, they come onto your location, they bring monitoring equipment, and they do 24 hours monitoring for as long as you have them there. And what they're doing is setting a baseline and finding emissions leaks and equipment that is failing or really a poor emitter. They document that, bring that to management, and then management has 6 months to 2 years or whatever the case might be to repair and replace as necessary. Right? Once that is done and you become a more efficient operator, then you get a designation of either silver, gold, or platinum based on how much the commitment you made. Right? So the operator brings them into field locations, and they do the monitoring and provide a report. They monitor on a well-by-well basis. So we don't do that, but we get those reports. And in fact, that is probably one of the primary ways of verifying ESG commitments, that you do have to have equipment on site to monitor. Otherwise, it's self-reported, which is not particularly reliable.
Tyson, we have another question. Eric?
Yeah, Tyson, I have two questions, maybe one question. Some of the states have started to move limit ESG investment because the states take a more traditional view of fiduciary responsibility that they have to the state pension fund and so forth. And they've noticed that the consistent ESG investment actually results in lower returns to the pensioners. ESG has been in complete favor, if you will, cultural, as cultural tailwind pushing it along. What are the chances that you're going to see greater liability in the future for ESG when the pensions start to have problems?
So Tyson, the question is, more states are moving away from ESG as policy because it's more costly. And do you or the panelists see, and maybe this is a great question for Jennifer, which is that, do you see liability in ESG policy?
Yeah, I've read some of that about the returns, that the trade-off, yes, is that you do have to, if you just follow the ESG ratings and guidelines and everything, you can have suppressed performance relative to what you need to make that pension, last, right? Because it's a long-lived, responsibility to pay pensions. Now, regulation legislation, I don't know about that specifically, but I think if you just look at the secular trend of that, there's going to have to be a splitting of the difference between ESG mandates and performance. And they can go hand in hand. And I think you'll see that converging more in the future, with, like I said, these large oil and gas firms starting to really focus more on how do we reduce, our carbon emissions. How do we get to net zero? Although that's a whole nother story. There's other pathways to get there that are not a goal of 1.5 or 2050. There's other pathways for all this. So that's very much in flux with the pensions issue. And it's a huge academic debate. And I've seen a lot of that research, but jury's out. And, but I think the oil and gas industry understands what they need to do, because they want to be, they're 5% of the S&P right now. They were down to 3%. It's projected they'll be 10 to 15% of the S&P again. To get there, you're going to have social buy-in, right? So.
Well, let's not confuse social buy-in with what you have on Twitter, right? Anyway, another question?
It was about social buy-in.
Well,
that
was good.
Bate?
Yeah, I was going to mention something real quick on the investment front. I think, investments perform, underperform. I mean, the market last year did terribly in some sectors. So you could make a case, right? Why was I in those sectors? That's always the case when companies underperform. I think that on the ESG front with oil and gas companies, if we're going to build a healthier society, it cannot be no oil and gas, and it cannot be anything goes, right? That ship has sailed. It has to be responsible, and it has to be decent. Asking all companies to improve their operations is not such an onerous requirement. Right? We should be doing that anyways. Having a clean business place is important. So that is necessary. However, when companies invest, they have to have a balance, right? It can't simply be I'm screening only for ESG. Because as I mentioned before, companies that are struggling do not make ESG commitments anyways. Mm-hmm. So you need healthy companies, profitable companies, and then you need either the lending community or the investment community to impress upon management the importance of being a responsible corporate player.
Right. Would you have another question?
Yeah, it's still around the same thing as whether you're the investor or whether you're the pensioner like myself. So I'm a California pensioner, and I actually got a chance to protest on the Golden Gate Bridge with a whole bunch of high school students who were petitioning or like basically rallying against CalPERS because of their investment in the tar sands pipeline. I mean, they can make better decisions, right?
So what's the question?
The question is more of a comment, sort of like, okay, so then ESG must involve, you've got, LNG over here, that's dirty. We're not going to do the dirty LNG, right? We're going to do the cleaner.
Eric, you got one more question? Do you have a question? Okay, great. So my concern with ESG, I think, is highly discriminatory for emerging markets. I think that I was reading recently, and I have an article that I might publish, which is that Nigeria's 95% of Nigeria's population does not have access to daily electricity or towards heating yet, and they are begging for coal-powered plants. And France will not share the technology with Nigeria, yet France gets 30% of its uranium from Nigeria. So it seems to be a lot of double standards in the practices. So and there's a whole bunch of policy issues. My other issue, obviously, especially with California, is that California energy prices are the highest in the country, yet because of ESG policies, California energy production is down 15% since 1995, right? So California sits on 3 billion barrels of oil. They produce 1 million barrels a year. And the net impact of all of the wind and solar is less than the loss in hydro that California has had since 1995. So, I mean, there has to be a net gain, or is that asking too much? Jennifer, any thoughts on that?
Yeah, I mean, this is something I actually went deep into the weeds about what you're talking about. I studied that very issue. It's about the grids. And so California, actually Pioneer sells natural gas for like 30 or 40 bucks to California versus $4. So that tells you something, right?
So it's a
Part of it
10x.
is they moved too fast, too quickly. Their grid couldn't handle it. This is the problem. This is the challenge with renewables right now. And I'm not going to go into the deep about it because I don't want to blow my story.
Well, I
but,
mean, the issue is that Texas is the United States' largest producer of renewable
Yes.
energy, right?
Yes,
So
well,
I mean,
and
Texas produces
that's
more
what
wind
this-
energy than anybody else.
Yeah, and that's the story I'm talking about. So we are at a crossroads because right now, so we have a ton of wind and solar. We're the top wind installed capacity. That is going to grow a ton because of the IRA. Everybody wants to come here. Everybody wants to build their plants. The problem is you got to connect them. You got to connect them to the grid. That's a reliability problem. You can add all sorts of storage, but that's going to take time and it doesn't solve the problem.
Well, the real issue also with wind is that the central United States is very windy because of the Great Plains, et cetera, and Canadian winds, whereas the coastal United States is not windy at all. So you have less impact from wind turbines than you have in places like Texas.
Right. Well, I think there's really going to be regional variation. This is the problem. See, you only have resources in certain places. Like Texas is hugely windy. The Midwest is hugely windy. There are offshore pockets. There's certain solar pockets where there's resource. But that's just going to affect things regionally because you cannot get, the solar of California over to the East Coast, right? Doesn't happen. The physics don't work. This is what the big problem is we're pushing up against the boundaries of the physical reality of the physical world and the idea of innovation. They're colliding. And we saw that in Europe. We're seeing that a little bit in Texas. And but Texas is unique. We have our own grid called ERCOT. And there's a real entrepreneurial, innovative, spirit, right? It's very, we're really capitalistic here, but it's, there's a lot of movement into Texas from corporations relocating here. And there's a lot of tech firms that want to set up shop here and they want green energy to reduce their, to say that, we're going to net zero and we're going to plunk down a solar plant next to our data center in Texas, and that's happening. But there's limits to that. There's a land use issue. There's grid issues, land use issues, all that's converging in power gen. It's just it's a big stew.
Hey, Tyson, I forget the name of the types of companies that do transport of energy and their energy services companies. What's the investment type?
Energy transfer, enterprise products.
But they're like REITs, right?
What is that?
What's the name of them again? Because there's a ton of them in Texas, right? They operate like REITs. They're pass-throughs.
Midstream
I'm sorry?
companies, right.
MLPs.
Midstream companies.
MLPs,
yeah.
exactly right.
MLPs,
So,
yeah.
so what's it look like? What's it look like? Are there renewable energy MLPs? Is that a good space?
I haven't seen many of those yet.
No.
I've not seen many of those
There was
yet.
a great MLP here in California. It was American MLP, I think. I think they were pretty good. And then you've got some fantastic ones in Texas, right? So.
Yeah,
But,
energy transfer, EPD. There's a ton of activity because also we have the Gulf Coast, which is a huge complex of all sorts of petroleum, products,
right?
And everything. And the Gulf Coast is also considered like a third coast or a fourth coast. There's the West Coast, East Coast, Gulf Coast, because of its and there's a lot of money flowing there because of the IRA legislation. Those hydrogen hubs, the Gulf Coast is a huge beneficiary. There is so much activity. Louisiana, oh my God, I mean, it's insane, the activity there. And that's just going to grow, you know, and they're going to take advantage of the CCS opportunities, the hydrogen opportunities, LNG exports, you name it. It's going to be a geographic proximity play, you know, of all these things, for sure.
No,
Yeah,
but
that's
I want to, you
fascinating.
know,
Right.
Yeah.
Yeah, I
Yeah.
just wanted to introduce a topic on regulation as that came up earlier, and particularly, you know, you just talked about proximity, but you know, earlier today we talked about shipping gas right across the ocean. How is the European regulation, right? So probably not many people here think on a daily basis about SFDR, and it sounds like it's you know, a local department, right? San Francisco Department of Recreation or something. But actually, it's a seminal piece of regulation that came into place in March 2021 in Europe, right, at the EU level, Sustainable Finance Disclosure Regulation, that really now forces any financial products to actually fit into a category which has a degree of ESG baked in. So it can either be Article 6, which means at least there's an understanding of ESG risks, right? So I can potentially produce pollution, all the way up to Article 9, which actually is what I would argue impact investing, where you have a sustainable investment strategy and objective, and you're tracking towards that. So I have heard that SEC is actually considering bringing in some form of that. So again, we're talking about federal level, which is interesting, how that will play with the state level, you know, kind of the state pension type of policies. But I'm just curious, because energy markets certainly are global, right, in nature. So are you already seeing that some of that European regulation is starting to change how global energy players are acting and thinking about ESG?
I think it's setting an example of overregulation and the problem of it. I think
Yeah.
that, you know, I think there's Harold Hamm, the CEO of Continental Resources, described the situation we've been describing here as too much EQ, not enough IQ. And basically, the thought is great, but the implementation speaks for itself. I think that the thought is great, but you know, Brown decided to eliminate all of their fossil fuel investments in their pension, in their endowment in 2019, very close to the bottom of oil prices. And you have to wonder how they feel about that decision now, when now people are starting to recognize actually you do need fossil fuels. They just can't be shut down and replaced with wind and solar, when people start to realize only 1% of US energy comes from wind and solar. And so I think that what the EU has done is they've done a lot of things that are very good, but I don't think that it necessarily is a blueprint for what we should do. And there's a lot of give and take. These are complicated problems, and you know, I think that those ideas are valid, but we have to be careful before we impose a whole lot of regulation when we need money to implement these changes.
And actually, Tyson, we talked about this before, which is that the footprint of a 1 square mile nuclear power plant is equal to a 50 square mile solar plant and equal to a 125 mile wind powered plant, right? So if you're talking about local environment, it's not great.
You know,
So
one
a
thing
couple
I
of,
would, oh, go ahead.
I was going to say,
Amazing
to
numbers,
end on
right?
a slightly higher note, you know, in this past year, I sat through probably 100 plus presentations and read through pitch books. 85 of those, about 80, at least 80, over 80 had an ESG slide, right? That is materially better than 2019 when under 10% did. So my point here is that there is movement, right? There's always a movement in idea.
Absolutely.
And then there's a movement in dollars committed. Now, on the European front, I was part of a project in 2005 or so to buy gas in Mozambique and move the LNG to Europe. Well, most European utilities did not want the gas. It wasn't because of price. It was because they did not want to be beholden to an American company providing that gas to them, right? Russia has changed that calculus, which has led to the boom in US LNG exports, right? This could have happened 10, 15 years ago, but there was kind of an ideological issue about getting both your defense and your energy from the US. Well, now there's only really one other option, and that really is the US. And so you see the growth in natural gas because the demand the contracts are changing long term.
You know, something I just wanted to mention too, in this YouTube video I did, I actually have a slide on the growth of LNG and where these projects are, and the ones that were in Mozambique, all the ones that were FID, they're not happening because of geopolitical risk. They're all happening here. All the LNG facilities are getting built here. And on this, the European regulation, you get to that issue that Macron was concerned about with our IRA legislation, that it would spark deindustrialization. But that movement of European large multinationals was already happening here because of our energy resources, because we're a #1 producer and a #1 consumer in the world. We're the top producer of oil and gas now. #1, we're an energy powerhouse, but we also have all the innovation going on with the transition. So I think we really have it going on. There's a huge bullish US case, and I think that's what Macron and the Europeans were concerned about with our IRA legislation, that we were going to also steal the green trade. But that was already happening because we're business friendly, so, and that has to do with not being over-regulated.
I think the political economic reality is that the USA has a bigger organic marketplace than Europe, and Europe isn't really good at that. I mean, it's been very good at selling German, industrialization to the rest of the countries, but just in terms of the consumption part, there's really nothing. It's not the same. So just pointing out to what you're talking about, Jennifer. Anyway, guys, can we get some parting comments here? I know we kind of talked about energy a lot, but any kind of guidance for 2023?
You mean where to invest?
That would be, well, yeah, sure, energy. I got it.
Yeah. Well, next. Yeah.
And don't talk about gold, Tyson, okay?
I don't have any comments than natural gas. I think that the energy market is making adjustments. They're painful. We're watching some people fall on their face, and, we're learning from those mistakes. And, I'm not a big fan of regulation, but, the reality of it is now big oil is starting to seriously spend on some of these greener efforts. But, this is not an easy transition. Anybody who thinks this happens in a matter of months or a few years hasn't done the calculus. Energy is very important to reduce poverty and raise the quality of people's lives. And I think that a lot of regulation and telling banks that they shouldn't loan to, fossil fuel companies isn't really the right policy. I think that there's a problem. We don't want to poison the earth. And I think that we're making changes, and it's just, it's like a sausage factory.
Can I just add
Sure
some
is.
nuance that's not exactly energy? Okay, so thematically, changing supply chains, also scale, and massive M&A activity in the energy space. That can also include gobbling up energy tech firms. So that's a little nuance to that.
Thank you.
Yeah, my one comment is that we're just seeing so many energy monitoring companies come out who are like monitoring energy efficiency, energy for apartment renters, apartment buildings, office buildings, trying to get optimum efficiency so that if somebody's not on the floor, you have a lot of floors where nobody's in the office, you reduce the air conditioning, you reduce the light usage, and it's all done remotely. So anyway, next, Bate.
Well, no, I think the last thing I was just going to mention, we talked about this, but didn't get a chance to do, is one of my clients recently at the presentation revealed something that has been in the market, but it was good to hear from the client directly, which is they bought an gas asset. Previous operator was flaring the gas, didn't really put the money into, infrastructure to sell gas. Well, there's not enough gas to make the investment, right? So they're simply flaring it. And in comes a Bitcoin mining company. And so they had an agreement, right? They simply redirected the flare gas to generate power for the Bitcoin mining company, which provides nominal revenue, but that's not really the interest of my client. It's the reduction in ESG, because they had been trying to figure out how do they get this flaring under control. They're a well-resourced company, money wasn't an issue, and then out comes this Bitcoin company, and it has made for me it's been a very good to hear from a client directly as opposed to just news articles. Because what it confirms is that even though prices are low for Bitcoin and it's kind of been a crypto winter, there is still stranded gas out there at remote locations that can be used to power machine systems and computing.
Yeah, that's a super
And that
interesting
should not be
story, which
ignored.
is, yeah, local usage of this stranded energy. That's interesting. We did something with Incutel 15 years ago, having to do with stranded energy sources and using it for processing on site. Any closing comments?
Yeah, just briefly again, to maybe bring it back to healthcare, that clearly it's also in healthcare a very attractive time to invest. I would be cautious when to invest in 2023, but certainly public markets are at a low point, and hence it's a great time to get in. Clearly, this industry continues to innovate. It's miraculous what's going on, and we love to contribute to that, but making sure that also there's sustainability, and there's actual broad access, so equity, because one of the downsides of all the phenomenal innovation that's happening and all the precision that's coming along with that, and really, call it Star Wars technology that's available now, including CAR T therapies, right? Curing cancer. It's incredible, but there's a very hefty price tag, and that does actually lead to obstacles. And so, let's not forget, financial returns certainly are important for sustainability, but we got to also bring in that social consideration, right? Ensuring that actually what we're doing is serving people equitably. I think that's just the parting comment from my side. And again, that's what we're hoping to do in this very dynamic and very productive healthcare